It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. My name is Mike Bernard. I am the host and also one of the certified financial planners on the show. With me in the KFG studios, like always, CFP Josh Gregory, but joining us today, CFP and CPA, the dual package, Ryan Fair.
Wow. Ryan, we're glad you're here. Hey, people often wonder whether they're better off filing their taxes as married, filing jointly, or separately. And we're going to put that debate to rest today and discuss some other tax planning considerations on today's episode.
Well, I didn't want to call you the dual threat, which I think is more common phrase, but you don't want to, when you're talking about CPA and taxes and threats, you don't want to mix those.
That's a good point.
Bring it on.
Hey, if you have a question, we've got some questions from fans of the show. Often those come on the YouTube channel, but if you have any questions, reach out to us. You can text us your questions, 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com. Submit a question right there on the right. And then, most of the questions come on the YouTube channel or anywhere on social media. So you can find us on Facebook, YouTube, or Twitter. Just search Wise Money Show and follow us there and submit questions there as well. All right, Ryan, welcome back. We've got a lot to hit, and I tell you, it's going to be a busy fall when it comes to taxes.
Man, you bet.
Lots of changes. I feel like we just got this on repeat because last fall, lots of changes. Fall before that, lots of changes. Like, my goodness, you've been busy.
Yeah.
You look old,
I am.
Aging.
Yep.
So, hey, all right, but we're going to start with an oldie but a goodie, and that is, if you're married, are you better off doing married filing jointly, or are there times when you're better off doing married filing separately? What do we get this question, a dozen times a year? Probably?
Oh, at least, yeah.
So let's put the debate to rest. Which one's better? Let's talk about that as an issue.
Okay. Great. Yeah, let's do it. If we didn't have to make a whole radio show out of this, I would just start and say file jointly. But there are a few examples where...
So you're going to stretch the conversation a little bit?
Yeah, I'm going to stretch this all out. So I'm sorry if I just killed the whole show.
No, you didn't. No, I mean, plain and simple, though, I think that is the case. If you're wondering... I mean, 99% of the time, you should file jointly.
Yeah. And yet the question comes up all the time because everyone wonders, okay, am I in that 1%? Do I have a scenario that maybe would justify it here?
Yep.
And I know we often turn to you and your team, Ryan, to look at the actual tax ramifications and quantify this for people.
Yeah, absolutely. And that's really the best time to do it is when we're doing the tax return. We can, with a little bit of extra work, we can actually run reports or scenarios that allows us to see exactly what a married filing separate tax return would look like and compare that to the married filing joint return. And we can tell you exactly how many dollars it's either costing you or saving you. Yeah. So it's a pretty cool ability that we have. That's why we pay so much for our tax software.
Yeah, sure.
Different bells and whistles that we have the ability to do and give clients good advice, on the fly.
So for most people, 99%, that is probably accurate. 99%. It's if you're married, you should file jointly.
Yep.
But what are some of the circumstances where filing separately might be appealing or beneficial?
Yeah, I mean, really, there's a couple of situations. Really, the most common one that we see that actually does make sense is if one of the taxpayers or both have some certain agreement in place with their student loans, which sounds crazy, but some employers have special deals, whether that's teachers or doctors. I've seen where they have certain packages set up where they can have part of their student loan forgiveness forgiven if they meet certain criteria, and one of those criteria usually ends up being filing separately, or they receive some other tax break due to filing separately because of their student loans. Mm-hmm. Lower interest rates maybe because they're considered more lower income.
Typically, it's lower payment, and if you know there is, this is touching a nerve.
Yeah.
If you know there's a pot of gold at the end of the rainbow, I've just got to travel this path, but once I reach this certain milestone, it's all going to be forgiven. Well, then you want to pay as little as possible along the way.
Right.
And the way to structure it to pay as little as possible oftentimes is to file separately so you're not showing a ton of income.
Right. It's in a circumstance where maybe your spouse's income would pile too much onto your tax return and then disqualify you from some of those student loan forgiveness goodies that could be out there.
That's risky, though.
Yeah.
I mean, they could change this deal tomorrow. Now, if they're going to change it tomorrow, they're probably going to add more forgiveness, which begs the question, should anyone really be paying using their own money for college? That's a topic for a whole different show. But yeah, those are typically the circumstances, because when you file separately, there's a lot of things that no longer count as options.
Right.
And so what are some of those examples?
Yeah, so if you do decide to file separately, and again, we're talking married filing separately, so this is different than, just saying single or head of household. This is specifically for a married person that's choosing to file separately. The first thing that gets reduced is the standard deduction. So married filing jointly, your standard deductions for 2020 is going to be $24,800. That gets cut in half for the deduction if you choose to file separately. Same thing with all of the tax brackets. So if you were in the 12% bracket based on your combined income, you may jump a tax bracket if you decide to file separately. Capital loss carryforwards could come into play. So normally, if you have capital losses, you're allowed to deduct $3,000 per year. That's if you're single or married. If you do married filing separately, that goes down to $1,500. So those are just deductions that we're talking about. There's a lot of impacts that are credits also that are even a bigger difference. The first one that I have seen affect people is all related to the education credits.
College credits and things.
Yeah.
Pretty much everything related to higher education credits and deductions goes away. So no more lifetime learning credit, no more American Opportunity Tax Credit, no more student loan interest deduction.
And these are really lucrative deals that are on a tax return. So if you're hearing that and you have kids in the later years of high school or going into college, and maybe you've been in the pattern of filing separately, it could cost you dearly. I mean, we're talking hundreds, thousands, maybe thousands of dollars each year on your tax return.
Yeah, absolutely. I mean, the American Opportunity Tax Credit's $2,500,
right.
In most cases. So that's gone if you decide to file separately. So, not as common, but adoption credits, those go away if you're filing separately. And then on the other income spectrum, the lower income spectrum, if someone qualifies for the earned income credit in a normal year with their filing jointly or singly, that earned income credit is no longer allowed if you are married filing separately.
This is another one of those that can really put a lot of money in someone's pockets if they qualify for it. If your income's too low by the government standards, then they actually can pay you some tax credit. Some people end up getting negative tax. Essentially, they paid no tax and still get a refund because of the earned income credit. And so to lose that all of a sudden by making a filing change.
Yeah. And in many cases, that's thousands of dollars, the earned income credit. The other important thing that I wanted to stress earlier is make sure that you do have this conversation with your tax preparer. I've got a number of instances where clients will come in or they'll drop off their tax document and they'll have a note written on the front that says, I want to file separately this year. Without knowing the true ramifications.
Sure.
If we just take the client at their word and say, well, they said they wanted to file separately, let's do it, that's a huge deal based on all of these conversations we just had.
Well, so there's some follow-up questions that we're going to answer here, and that is, well, what if you were legally separated? Do you have to file separately? What if you just got divorced? Can you still file jointly? And there's some other impacts relating to contributing to Roth IRAs, those sorts of things. So a lot more to come here on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. You're at the Wise Money Show channel. Thanks for being here. If you're not a subscriber, hit that subscribe button, turn on notifications, and smash the thumbs up button if you like if you like the content. What you're watching right now is our weekly 1-hour talk show that airs right here every Saturday morning at 10 a.m. Eastern Time. It also airs on a couple of local radio stations in northern Indiana. So make sure you check it out. If this is too long for you, then we actually provide bite-sized nuggets of financial wisdom every single business day of the week, Monday through Friday. So check that out as well. We call those our Next Wise Steps, and those are more palatable, taking current financial information, applying it to your life, helping you take your next wise step in your life. So make sure you hit that subscribe button, turn on notifications, and smash the thumbs up button. We appreciate it. So, okay, Roth contributions, right?
Yeah.
I don't know about HSA.
I didn't get into any of that.
So that's where I can give an example about that. And then I do think we talk about legally separated and divorce.
Yes.
Okay.
Yep.
And
yeah,
then,
all of that filing status and when it's determined and all that stuff I figured we'd hit.
Mm-hmm. And then is there anything?
Is there one more? I mean, you had asked the question, are there times when filing separately can make sense?
Yeah.
And I think you went into it financially makes sense under these circumstances, but are there other times when it just makes practical sense too?
Yep.
And maybe we work that into
Sure.
a separation or divorce or whatever.
That's great. All right. If you are legally separated, can you file a joint tax return, or would you have to file married still, but filing separately? Can you file a single return? We're going to talk about that right now, dispelling the myth of whether if you're married, should you file joint or separate. All right, this is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFG studios, Joshua Gregory and special guest CPA CFP Ryan Fair. Every single episode of the Wise Money Show is on the YouTube channel, so check it out there. Go to YouTube, search the Wise Money Show, subscribe to the channel, and you can leave questions and comments there as well. We appreciate it. All right, so we're talking about the big debate of whether, if you're married, whether it's more, I mean, if you're single, you can't choose.
No
you can't choose married, right? So there we go. Show's over.
Yep.
You're welcome. No, if you're married, is it better? Are you better off filing jointly or separately? And 99% of the time, just file jointly. File jointly. We've got the ability to quickly do the analysis and say, here's what it's saving you, or here's what's beneficial. Let's get into the issue, though, of whether you're legally separated. I mean, oftentimes, if you get that note that you're talking about, Ryan, where someone drops off all their tax documents, and there's a note in there that says we're filing separately, typically that's because of some strife in the marriage sometimes. And so if someone's legally separated, do they have to file married filing separately?
Well, yeah, if they have a separate maintenance agreement, they do have to file separately. Mm-hmm. So that's the case of legal separation. If someone's just going through, a rough patch and one of the spouses got demoted from the couch to another location, and they are, truly not living together, but they're still legally married. In that case, you do have the ability to choose married filing jointly or married filing separately. That's just, an example of a rough patch in a relationship.
It's just going to require that you collaborate together at tax time, make sure that you get the taxes filed on time and accurately and everything. So, sometimes there's the practical matter of, well, we're not really talking right now, or we're separated to the point where a lot of communication is a struggle, and so sometimes it's hard to get a tax return done. Something even just as administrative as filing a return, that can be difficult, and that's often why sometimes people will file separately. But the point is, and if you're just joining the show, maybe you wouldn't have heard us talk in the last segment about all the costs, all of the downside to filing a separate return when you're married. There's a lot of goodies that you give up, and so you just need to know that. You have every financial incentive, many financial incentives, to try to cooperate and get that return filed together.
Yeah, and on that note, I mean, we talk about the relationship and actually cooperating together to file a married filing separately tax return. You really do have to communicate in order to file separately. The reason is if one taxpayer chooses to itemize deductions both taxpayers have to itemize deductions.
That's right.
You have to be on the same page with that stuff. Or, for example, if you're both living, or you both own a house together, but only one of you are living in it, or whoever gets to deduct that mortgage interest or property taxes depends on who paid it, or however you guys decide to split it. You got to communicate to work through that stuff.
And same with kids,
I was just going to ask about kids.
Yeah, that's huge. So yeah, the kids, you can't both claim the same dependent child, and you have to communicate and work that stuff out.
So here's the point: get your taxes done as quickly as possible. I'm just kidding, but it's not uncommon for us to go through a circumstance with a couple, and we file separately based on their request and claim a child, and it's rejected because that Social Security number of that child was already used on a tax return.
Yeah, that's right. Sometimes it's the college student who's away from home who went and filed their return without consulting with mom and dad too.
More often than not.
That stuff can happen a lot. There's another scenario here as well where maybe it makes practical sense to file separately. And the times when I see it most commonly is during with a client who is in a second marriage. And maybe they've been divorced before, or they just have never really truly merged their finances together because they just agreed up front, hey, what's yours is yours, what's mine is mine. We're going to just keep everything separate, and that includes filing returns separately. And they may just not know up front exactly what that's costing them financially. It's not that there's animosity or that it's some sort of source of conflict in their marriage or anything. It's just, hey, that's how we agreed upon this when we were kind of bringing our two households together.
Yeah.
Another example that I can think of, when you file a joint return, whether you're happily married or unhappily married, you're both signing that return saying that everything on this return is true and correct. You're both on the hook for any tax liability on a joint tax return. Some cases I've had where a spouse will come in and say, hey, I guess we'll say husband. Usually it's the husband. He's doing something that I don't agree with, and he's not reporting it to the government. I don't want to sign that return as a joint return. So let's prepare mine separately, and he's on his own with any ramifications that come up as a result of what he's doing right now. So I mean that's an example that's real. I mean I've had clients bring that in. So
in the process of a divorce, and obviously, hopefully, there's reconciliation and everything. But in the process of divorce, those are lengthy processes.
Yeah,
and you're often not going through a legal separation and then a divorce. You're often going through the divorce, and as that spills from one tax year to the next, if you're not officially divorced as of 12/31. You can file jointly or married filing separately. Technically, it means you're still married on 12/31.
Yeah, all the filing statuses are determined on that last day of the year. So could go either way. If you finalize your divorce on December 30th, you can file, or you only can file that tax return as
single or head of household if you have a qualifying child.
Right. So you can't file a joint return if you were divorced on December 30th. And a lot of people are confused by that. And they're saying, well, wait, 364 days of the year we were married. Nope. It's all based on that final day of the year. Same thing. I know that this isn't what the show is about, but the same thing when clients get married.
Yep.
A lot of times they'll come in and say, hey, we're going to file separately this year. We got married, back in September, and, we just want to keep things separate. And that's a good chance for us to educate them and figure out, dig a little deeper and figure out why they truly want to file separately.
So
it's usually,
if you think it'd be so romantic to get married on New Year's Day, just get married on New Year's Eve.
Yep.
We actually had a friend and colleague, Ben DeBach, one of our CFPs here, got married on New Year's Eve. He claims it was out of love, not for the tax reasons. But we'll see.
I beg to differ.
He is a financial planner. Hey, really quick, Ryan. In a divorce, after a divorce, who claims what kids is pretty confusing. Can you clarify that within just a few seconds for us?
Yeah. So it's all comes down to the custodial parent. So anymore, the IRS has said, hey, we don't care what's written in the divorce decree. It's based on the custodial parent. Where did the kids sleep the most nights for the year? the parents can agree to, the custodial parent can agree to release that dependent child every other year or whatever the agreement is, but they have to sign off on an IRS form that says, I'm the custodial parent, but I'm releasing this to the other parent for this year.
What if you just have a friend that does a lot of sleepovers with your kid? Can you claim that kid?
If it's over half the year and you're providing a bunch of support with Let's Talk.
My daughter's on a travel softball team, and the girls rarely spend the night in their own house. So anyway, all right, we've got some other changes. There's changes with withholding. Your W-4 is gone. It's gone. That thing is blown up, and they've got a new W-4 out. And then what about the new 1040? Ooh. Spooky. We're going to talk about that and more coming up on the Wise Money Show with Korhorn Financial Group. Is it okay to talk about sleepovers during the coronavirus?
No.
I don't want to freak anyone out.
You are going to get some hate mail for that.
I probably will. All right.
Of course, you make her wear a mask to bed and everything, right?
I do, yeah. That's right. That's right. I actually think
the Big Ten.
There's a round-robin softball tournament this weekend, and I think we're having a sleepover at our house. Maybe our house won't get picked. I think I'll sleep over at someone else's house.
You better hope none of the other parents are listening right now.
Yeah. So, anyway. All right. Well, let's get into the W-4. Okay. And that can show. So this is the third segment. So we'll wrap up here, and then we got a couple tax questions that we'll get in the fourth segment. So this is the third. Start with the W-4, and that could actually take the whole segment when we might wrap up 1040 stuff but this is the last segment that airs on WFRN. So, I forgot to do my intentional pause last show.
Oh, it's real easy to get it out. Yeah.
Okay, sweet. All right. Do you need to change the tax withholdings on your paycheck? Good luck.
Yep.
Good luck. It is crazy. They changed the system, and actually right now we've got two systems working simultaneously, and they both are terrible. We're going to try to help you make sense of it right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Joshua Gregory and special guest Ryan Fair. For submitting questions, we always try to work in some questions from fans of the show. We'd love to hear a question from you. You can leave those on the website, wisemoneyshow.com, or all over social media, wherever you're at, we're there too. So connect with the show, engage with the show that way. All right, so let's pivot. All right, tax withholdings has been just an absolutely disaster for the past several years. The W-4 form, you know it by, married filing, or married, single, this exemption, married 0, married 1, single 2, whatever.
Choosing all your allowances to figure out how much they're going to withhold for taxes out of your paycheck. Right?
Yeah, that's W-4.
Those are the old days.
It's all changed. So what's going on, Ryan?
Yeah, so beginning with 2020, as a response to the tax changes that were made a couple years ago, the IRS decided to kind of redo everything on the W-4. So in the IRS defense, they had good intentions because it is difficult to do withholding estimates based on the new tax law and multiple jobs.
Difficult or impossible? My goodness.
I know. It used to be difficult. Now it's impossible. So the new form, they said, hey, we've got to account for all these big child tax credits that are in play now. They doubled them a couple of years ago from $1,000 to $2,000. But then also multiple jobs when employees or couples had different multiple jobs that they were getting paychecks from. That really messes up the withholdings on a normal paycheck because the employer does the payroll like the IRS says, and let's say they're making $5,000 here and $5,000 at another store. The employer, using the IRS tables in the old days, would not withhold hardly any taxes on that paycheck because they would assume, okay, this person's only making $5,000. they don't need withholdings.
Ryan and I have an example for several years, and we fixed it, but it honestly took a couple of years where an individual was a manager for a few different chain fast food restaurants, and how he was paid, not our choice, but how he was paid was about a $25,000 salary from this store, and a $25,000 salary from this other store, and a $25,000 salary from this other store. So each store, though, even though they had one common owner, the payroll from each store through the IRS withholding system looked and said, well, this individual, he's married, is making $25,000 a year. We don't need to withhold that much.
Yeah.
So each one barely had any withholdings, but he made $75,000.
Right.
And on top of his wife's income as well,
Yeah.
you should have had a lot withheld.
Yeah. Yeah, and so that was the problem that the IRS was trying to resolve. And if you can understand the new system, it may work. The problem is understanding it. It's so difficult and time consuming to actually fill out a W-4 accurately these days that most people kind of give up and throw in the towel, trying to do it. So as we mentioned, all of the allowances that you were used to in the old days, those are gone. So you can't just go to your W-4 and say, I'm married and I've got 2 kids plus me and my wife, so I'm going to put 4 allowances on there and I should be good. Allowances are gone. Those are no longer a thing. So instead, what the IRS is basically wanting you to do, they have a tool on their website. It's called the Tax Withholding Estimator. And basically, you're going through that application and doing a mock tax return or a tax projection of what you think your total income is going to be for the year. If there are multiple employers involved that we talked about between obviously husband, wife, or if one spouse or the other is working multiple jobs, to go through this estimator, you have to have all of the current pay stubs from all of your jobs. You have to have a copy of last year's tax return with you because you're using some of that information. Now, if stuff is changing this year, if there's a reason you're changing your withholdings because, you make more or change jobs or all of that stuff, some of last year's information may not be relevant. So you need to come up with salary projections for the remainder of the year. What if you're going to itemize deductions and not take the standard deduction?
Yeah.
You've got to be able to project that and provide that information on this estimator tool on the IRS website to do this. So investment income, it's another, or pension income that may not have the right withholdings. You've got to take all of this into consideration, and man, it's tough.
If this is sounding like a headache that you don't even want to mess with, that's part of the reason why before the show started, we were just kind of chatting about this new calculator, and we referred to it almost as complicated as building a tax projection, which is the work that we do with our clients, for our clients every fall, and sometimes more often than that even. But it's almost like building a tax return altogether.
Yeah.
And why they came up with this system, I don't know. It's like they were looking for accuracy and precision and gave up simplicity and speed.
Absolutely.
Right?
Yep. Yeah.
You if you're listening to Ryan, for the couple of you that still are after that explanation, you might say, well, wait a second, he's wrong. He's wrong. I look right here on my pay stub and it still says married with 0 exemptions. Yeah, they're using both systems at the same time. So thankfully, I think this would have been disastrous. Thankfully, at the beginning of the year, if you already had it in place, they didn't change what was happening.
Right.
You're still if you haven't changed jobs, or your employer didn't change payroll providers, or they didn't force you to fill out one of these new W-4s, you're still having single 0 or whatever you were. But it's now, if you're like, okay, the kids are out of college, those tax credits are gone, let me make a change, you now are faced with the new system. You can't say, yeah, I've never seen this before, let me just make a change on the old system. You can't. If you switch jobs, you're going to face this new system. You can't go with the old system. So they're running both in tandem, but the old system is getting phased out here. It just wasn't an abrupt stop.
Yeah, it's just a matter of time. I mean, the new one rolled out, 1/1 of 2020, and so as time goes, they're going to be switching everybody over.
So here's the reality: every year, and So every year we have 2 busy seasons at Corhorn Financial Group. We do several thousand tax returns a year, and that makes the spring a very busy season for tax prep and a lot of planning. But then the fall is very busy too, because we're doing tax planning, which is one of the areas of the 6 areas of your financial life. What is tax planning? Well, let me take the simplicity and tell you it's avoiding surprises and capturing opportunities. How do you avoid surprises? You do a tax projection. And because, if you followed me this far, because this new withholding or this new W-4 withholding calculator is basically a tax projection, guys, you pretty much need to do it every year. You really do, because from year to year, it tells you here, if your income's in this range, multiply the number of qualifying children under 17 by this. Well, do your kids have a birthday every year? If they do, you probably need to fill one of these out every year. Figure out, what other investment income are you going to have, dividends and capital gains and so on. Does that change every year? Yes, it does. Are you going to itemize your deductions? Yeah, well, mortgage interest. Does your mortgage interest, the total amount you pay in interest for your mortgage, does that change every year? Yes. So basically what this has done, if you want your withholdings to be anywhere close to accurate, you need a tax projection every year. And then working with your CFP and your CPA, they can help you fill out the new W-4 form. I know I mean, anything you'd add
Go to
there
Mike with any of those requests.
No, contact your certified financial planner. If you don't have a CFP that is working with your CPA that's helping you with tax planning, then call us. Absolutely. Our team is equipped to help you with this. All right. We've got questions from fans of the show, as well as a couple other changes we've got to hit. That and more coming up on the Wise Money Show with Corhorn Financial Group. All right. Sorry for monologuing there.
Oh, that's good.
But I mean, it is. I was looking at this and it's like, it's going to change every year for many people.
Yeah.
So you got to go in and fill out W-4 every year?
Right. And even if it's not your kids growing up and aging out of certain tax benefits and things, it could be that maybe you were itemizing deductions and now you're not. And,
right.
Your withholdings, just because they were appropriate last year doesn't mean that it's appropriate again this year.
And I think the new form, the IRS is trying to get people closer to break even as opposed to refund mode, which, means if you're at break even and something changes,
yeah, you don't have much margin of safety
there's
there.
not much margin, and you're going to end up owing, and most clients get pretty ticked when they owe.
Right.
Especially if it's different than last year.
Yeah, especially if it's different than the past 10 years.
Right.
Great point. Well, let's talk about the new 1040 really quick.
Yeah.
And it's still in draft form, right?
Yeah.
Okay. What's the likelihood that, usually when they post a draft, they're pretty...
Yeah, it's pretty solid, but there's still stuff subject to change.
And then a couple questions when we get there. So there's a question here from Nicholas, basically about his unemployment is really, it's really low after taxes. And I'm not going to say the exact question. I'm just going to talk about, hey, unemployment and taxes.
Okay.
And so we'll talk about that. And then there's another, at what point can I gift money to my grandkids? Is there a tax advantage or disadvantage? So hopefully we can get to those two. Okay? And this one's 4 segments, so 13 minutes. So,
Got it.
all right. Thanks for being here. This is the Wise Money Show with Corhorn Financial Group. My name is Mike Bernard. Here with me in the KFG studios, Josh Gregory, and special guest CFP CPA Ryan Fair. We're talking about taxes, tax planning, everything you need to know about that. Every episode of the Wise Money Show is on podcast, whether you listen on iTunes or Spotify or wherever you're at. Just search the Wise Money Show, subscribe to it so every single episode gets sent right to your device wherever you consume podcasts from, and even rate the show as well. We appreciate that. All right, before we get into questions from fans of the show, we got a couple great tax questions here that I'm sure you're going to want to hear the answer to. Let's talk about one other change potentially that's in the works, and that is yet another look at the 1040.
Another facelift.
Right. It hasn't changed much for a long time. It's just gotten longer and longer and longer. And then wham, Trump tax laws. We're going to put this thing on a postcard. Oh yeah, we can't.
No.
And so what are the expected changes with the 1040 this year?
Yeah, so 2 years ago is when the IRS really snapped that. They tried really shrinking down the 1040, and they shrunk down the front page, but then they added 7 new schedules. So that kind of didn't work. So last year, they kind of reverted back closer to what it was, a longer tax form instead of the half page. This year is kind of along that same vein. It's definitely not even close to a half page anymore, so I guess that's good. There's not as much blank white space, but yeah, the IRS did release their draft tax forms a few weeks ago. So yeah, not a half page. One of the things that I found really interesting, on 2020, right on the front page, there's a new question asking if you had anything to do with virtual currency.
Why do you think that is? And that is, so have you, the specific question is, have you bought or sold, right? And
that's what it was in 19, but
Okay.
20, it's more specific, where it's not just have you used virtual currency to buy something. Now it's more vague, where it's basically, do you have any involvement with virtual currency? Buy, sell, trade, whatever.
So why is this?
Well, if you go back and look at the stats, the IRS has a huge suspicion that nobody's reporting their virtual currency transactions. So
Virtually no one is reporting it?
Virtually no one. So yeah, if you go back a few years, it's, obviously they've increased over the years as more people have obviously been using virtual currency. But back in the days where it was more the underground market,
Right.
They had like a few hundred people that were reporting it, where there's, thousands. And
I'd love to see the stats. How many people check yes or no? And then if you check yes, is there another form that you have to fill out? Does it automatically create another schedule?
I don't think so. So I think it's
put
an
a target.
information gathering. Yeah, you put a target on your forehead.
You're now an audit target there.
Yeah.
So basically, pretty soon, guys, this question, this Q&A at the front, it's going to be, have you had anything to do with virtual currencies? Have you sold anything on eBay?
Yep.
Have you, do you own a business that's really a hobby and you're deducting losses?
Yep.
I think they're going to be much more simple than that. They're just going to say, are you hiding anything from us? Check yes or no.
Actually, it's going to be pre-populated, yes.
Right.
Oh, my. So anything else, any big changes?
Well, that's the most noticeable one that caught my attention. I mean, a couple of other small things that will help people. This year, so basically charitable contributions, as people that don't itemize deductions because they doubled the standard deduction a couple of years ago. People were giving charitable contributions and really getting no tax benefit from it. This year, the IRS has started allowing a relatively small charitable deduction on the front page of your tax return. Mm-hmm. So basically, it's $300 per person or for single return, $600 for a joint return. You can deduct up to that amount on the front page of your tax return as a charitable contribution. That's even if you don't itemize deductions.
That's if you don't itemize.
Right.
If you do, it's not it goes on
Schedule A.
Schedule A.
Yeah.
So here's the thing, though. If you are listening to this and saying, oh, well, that's neat, and then it escapes your mind and you start filling out your tax return in February and you look and you're like, oh, yeah, I meant to do that. Let me go donate some stuff to Goodwill. Nope. Yeah. You've got to do it this calendar year. Right. So it's got to be to a 501c3, and it's got to be this calendar year. And if you do, when you fill that out, I think this is 1 year only, right? It's part of the CARES Act.
Part of the CARES Act. So I would assume. Have you read anything if it's cash contributions or non-cash contributions?
Oh, I haven't. Have you heard cash?
I really haven't, but I suspect it's going to be cash.
I would suspect the same thing. Yep.
Yeah.
I
haven't read that yet, but
I think the lobbyists at Goodwill and
Salvation
Army, yeah. All right. We're actually going to be doing an upcoming show on all of the tax changes related to CARES Act because, yeah, the IRS has been tinkering with some things here, withholding schedules, that sort of stuff. However, the CARES Act just took everything you know about taxes and finance in particular and just threw it out the window, came up with their own rules. So we're going to break all of that down in an upcoming episode, so make sure you tune in for that. And then usually we have Ryan join us a few more times throughout the year talking about tax planning. So let's transition to questions from fans of the show. A couple tax questions here. The first one is from Nicholas. He left it on the YouTube channel a few weeks ago. It's basically about unemployment. Now, he was listening to, we posted several videos warning folks that are on unemployment or have had unemployment that, listen, it's going to be taxable. So make sure you're aware of that. Now, Nicholas's comment is, hey, net after taxes, I'm only getting $40. And I'm saying that math doesn't add up, buddy. Mm-mm. So you need to work with your accountant and say, here's my actual stub, my printout from my state unemployment agency, unemployment office, calculating, breaking it down.
Yeah.
But let's talk about the taxability. Is normal unemployment taxable? Is the extra $600 the Fed was doing, is that taxable? Is the extra $300 that the Fed or states were doing, is that taxable? How's that all break down, Ryan?
So the short answer is yes to all of that stuff. So unemployment in any year that you receive unemployment is normally taxable. This year, it's still taxable, even though there's a pandemic and even though there's the CARES Act. So all of that unemployment, whether it's your regular state unemployment or if it's the special extra $600 CARES Act bonus or the $300 CARES Act bonus, that is all still taxable as ordinary income.
You mean the government's going to give you $600 a week and then want some of it back?
Yes.
Crazy.
Yep, I know.
Okay.
So yeah, it's all going to be taxable. And hopefully when you signed up for unemployment, you at least had them do some withholdings.
I think if you elect to withhold, they only withhold 10%.
10%, yeah. I say it's not a lot, but it's a little bit, kind of a down payment for most people that they at least are withholding some. If you didn't do any withholding, some people are getting pretty substantial amounts of unemployment throughout, the annual.
Well, wouldn't you say that the people that those of you listening or watching that have a lot of unemployment have really had a very difficult financial year? And to have a lot of unemployment and a difficult year to then be clobbered with a tax surprise would almost seem unfair.
Yeah.
And yet that's the reality.
Yeah, absolutely. And a lot of times we'll see it where, one spouse is off where the other one still has a great job and still doing fine. So, they may be in a, 22, 24% tax bracket, and then if the other spouse is on unemployment and only having 10% withheld, even that extra 15%, of tax, it's a blindside.
Especially when you throw in these extra perks, the extra $600 per week.
Yeah.
All right. So what about states? Now, hopefully you live in a state where there is no state tax, and sorry about your property taxes. But in states like Indiana and Michigan, have the states come out and said what they're going to do? Because sometimes they flip-flop.
Yeah, they haven't said a whole lot about it yet, but in a normal situation, it is taxable.
It is,
and so I'm still counting on it being taxable.
In Indiana, they used to it's taxable, and you couldn't even withhold for the state.
Right.
Now I think you can.
You can. And so they do withhold for state. And I think I see county withholdings on the unemployment also. So.
Well, that's one of the things I used to gripe about.
Yeah.
It's coming from the state. They are going to tax it, and they won't even let you withhold against it. So, all right.
Sound like an old man, Mike.
I know. Well, I am. All right. So here's another great question. This one's actually local. Carmen from Niles, 59 years old. At what point can I gift money to my grandkids? Is there a tax advantage or disadvantage?
So anyone can gift money to their grandkids anytime. So, Grandma, if you're listening, I'm still your favorite.
Too late.
Yep, it's not too late. No, you can gift anytime. The annual contribution or annual gift tax limit's up to $15,000 per year per person, and if you do that or under, you don't have to do anything. You don't have to report it. The recipient doesn't have to report it, and it's not a deal. I mean, it's not a big deal. It's a piece of cake. If you give over that, it gets a little bit more dicey, but it's still not taxable to you or to the giver or the recipient. You just have to file an annual reporting gift tax return.
The giver needs
Correct.
to just tell the IRS about it.
Yep.
And so how do you tell the IRS? Do you write it on a sticky note and, send it off? No, you file a tax return. That's how you do all your love letters to the IRS.
Yep.
We in this scenario, Carmen lives in Niles, just across the state line into Michigan. We don't know what state these grandkids potentially live in, but it's not uncommon for us to see grandkids in Indiana, grandparents in some other state. And, a way to start leveraging some tax benefits here are to actually make the gift to the parents in the form of opening up maybe a 529 plan for those grandkids. 529 plans, as you may recognize, those are college savings vehicles. It's an account that you can purchase mutual funds in and grow a pool of money for the eventuality of college expenses. And the advantage, though, that the tax savings comes in the form of a state tax credit in Indiana. This is one of the unique things about Indiana's tax laws that we just love. For the first $5,000 that you throw into one of these accounts, you save 20% of it in the form of a tax credit. Or in this case, the scenario I'm talking about, your children would save it on their tax return as they open up the account essentially for their kids. So, obviously the giving money to grandkids, there's always the can you? Yes. Should you? Depends on the circumstances. There's great ways to give money to grandkids, and then there's some that could maybe have unintended consequences.
To wrap this up on the giving issue, $15,000, anyone can give anyone else a year, not need to report it. And there's gift splitting, right? So if a married couple gives one person, then it's 15 and 15. That's called $30,000. And if the person you're giving it to is married, now that's double. That's 60. So anyway, Ryan, thanks for being on. That's all the time we have for today. On behalf of Josh and Ryan, myself, have a great weekend. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.